Let's get going. So, welcome to Play with Unicorns, episode 6. This week we're going to be discussing whether or not first time entrepreneurs should be building companies on their own, should be joining an accelerator, or should be joining a studio. Let's get to it. So joining us this week is Nancy Dong, who's in the IR at FJ Labs, who's going to be actually helping us talk through how she went through this process for herself. But before she explains, why she went through the process, maybe we can have her give her a little bit of background on who she is and how she ended up being here and in a position to present this. Nancy, go for it.
Awesome. Yeah, happy to, Fabrice. Hi, everyone. Super excited to talk through a bit of my background and decision making here to hopefully help you. Background on myself, I grew up right outside of DC in Maryland, generation immigrant family. Went to undergrad at Northwestern, studied economics, spent a bit of time in consulting, and then spent a little over 4 years at Uber. It was back in 2014, and I've been an avid customer for forever. Made all my friends download it and jump into cars with strangers. And I was like, oh, I should actually just go work for this company. So in 2014, I joined when we were sub 800 employees. 4 years later, we were at 20,000 employees globally. So I also had an opportunity and was very lucky to play a role in many different geographies and business lines. So initially started on the right side of the business where I was managing territories and launching markets on the West Coast, based out of San Francisco, spent some time in Beijing as well with our Uber China business, and then moved over to Uber Eats back when it was just in a few cities and we're figuring out business model and trying to scale up. Ended up with a launch team in Latin America and then a regional eater operations team, which was more focused on product and analytics. And then 2 years ago, so fall of 2018, I ended up going to Harvard for my MBA. Decided after a year when I actually did my summer internship with FJ, and FJ was the only info session I went to on campus. It was by accident, bumped into Fabrice, and I was like, whoa, I want to work for this guy. So do my summer internship, and I was reevaluating, what am I trying to get out of my second year MBA program? Decided to drop out, actually, and I have a lot of thoughts on MBAs and higher education, but not for this discussion. And ended up joining FJ full time. Very, very happy about that. And I came to this, what is this presentation and analysis today, essentially back in March, April this year, a few months ago. I was signing my full-time terms with FJ Labs as an entrepreneur in residence. And, part of that is because Fabrice is investing in me as a founder pre-idea, and because of the way our studio is set up, I also agreed to terms upfront. And so as part of that exercise, and I started, Googling studios versus accelerators, how do I decide? And I just kept running into roadblocks where people were defining them super differently. There was no apples to apples comparison of terms that post-seed fully diluted, excluding ESOP and all these things. And I then talked to a bunch of my friends and mentors and former colleagues to get their thoughts as well. What pathway should I go? Should I go with FJ or should I, forge my own path and go it alone? Got a lot of conflicting advice. It was pretty hard to digest. So I was like, let me just analyze this myself and build my own comp set. So ended up building out a pretty robust comp set of 70 different accelerator studios across the world to understand, what are the trade-offs that I'm really considering. And there was so much information asymmetry in my research process that wanted to roll it up here and talk a bit more for any founders in this audience who are thinking or debating between, hey, do I try to figure this out myself, or maybe go the YC route, or go after a studio model.
And I think this is really important, especially for as a first-time founder, right? As first-time founder, there are a lot of things you don't know, and so actually, the studios and accelerators can be helpful if and so if you're a second-time founder, I think that the metrics or the thinking would be different, and there are a few exceptions to that, and I'll address them in the end. But Nancy, take it away.
Sure. So, yep, here are I would describe as the three main options as a founder, and describing this a bit further. So, do it yourself. I think that's pretty straightforward. A lot of my founder friends they forge their own pathway and figure out who are my key advisors, like how am I going to support myself on this journey of 0 to 1. And I'm also finding with increasing frequency that my first-time founder friends are also supplementing with communities such as On Deck and co-working spaces, at least in pre-COVID, in order to help them on that journey alone. The second bucket are accelerators. So these are probably the most well-known. So YC, 500 startups. Accelerators are what I would describe as more time-gated, like typically 2 to 3 months, where there's fixed programming all the way from start to end, where it's, you have sessions on this is how you build your pitch deck, and typically ends and rounds out the programming with a demo day where they invite investors to come see who's pitching. And typically accelerators put a small amount of seed funding for your business, and it is a application process. And one distinction here that I see emerging is this then breaks down into what I would describe as pre-idea accelerator versus applying with your set business idea in mind. So, for example, Entrepreneur First and Antler are emerging focused on earlier side of talent, where you come in, you apply as a founder, but not necessarily with a fleshed out business idea. And part of the goal of the program is to actually find your co-founder within that cohort, and figure out what you want to build together. So this is also starting to move upstream earlier. And then the third bucket are our studios. So this is where you're going to see the most variation in models. So the biggest distinction between accelerator and studio is more resources, more funding. Obviously, the trade-off is dilution, which we'll get into in a little bit. But there's so much variance in this bucket as well. But in general, these are firms that co-build with you and have way more dedicated resources from ideation to validation, to MVP. And you have on one side investing earlier in talent like FJ Labs, like Inovia, where they'll bring in founders pre-idea. So, for example, right now I'm working through and iterating through what is the idea and company that I ultimately want to build, all the way to you have more of the like redesign health, science, atomic models, where there will be an internal research and development group that will have like very systematic processes around doing market research, ideating, like funneling that down, and experimenting to figure out, okay, if we have a hypothesis on one idea internally and then get it, let's say 70, 80% there, and then we go source and figure out who is the founding CEO we want to bring in. But that's typically later stage and more oriented around their internal studio research team coming up with more of the ideation and then bringing on the founder later. So you're going to see lots of variation in this third bucket of studio compared to accelerator, which I think are more similar, comparable terms today. And then, so this is a set of questions that I wish I had structured out for me a year ago, in terms of what to consider when figuring out pathway. So here are the three buckets: advisory, financing, resources, in which I'll kind of walk you through how I thought about it. But I think this really stems from a very serious and in-depth self-reflection on what am I good at? Like what do I know? What do I have expertise in? What environment is going to unlock my full potential as a founder? Because ultimately, if you're considering accelerators and studios, what is underlying that decision is, okay, how do I de-risk and maximize my chance of success at building a company? And, for me, when I was going through this process and it's self-reflection process, I was like, whoa, I took a step back. I looked at a lot of my founder friends who were former Uber colleagues or people in my network, or, even from sitting on the investing side at FJ. I was like, wow, there's a lot of dead bodies here. You see really, really smart people and teams and capital being allocated. And, maybe 3 years later, it's like, oh, shit, like they're dead. And maybe there was some upfront work or assistance or resources or some gap that could have been filled earlier in order to better de-risk that ideation validation process. So I'll go through and talk through example decisions for each of these buckets. So for example, advisory. So when I ask myself, okay, who do I know today? What expertise is in my network to help me figure out a venture-backed business as a first-time founder? And also when I look at my prior experience, I was like, oh, okay, I have previously managed teams, like ran toward metrics for ops, marketing, data science, sales, account management. Like I understand all these different functions, but I know nothing about fundraising. Like 2 years ago, I could not tell you what a cap table was. I couldn't tell you what a lead investor was versus a co-investor. There are so many dynamics within the VC ecosystem and how you just think about venture capital as an asset class and how to build a I was missing this pretty core piece on understanding fundraising. I also thought about my network, and I was like, oh, I know a lot of smart people who are typically younger operators, and it tends to lean toward my Uber network, which is filled with amazing people, but for that type of expertise and that capital funding time, as well as Uber's anomaly tech company and how it was scaled up. I was like, oh, I need broader, more hands-on guidance for what works in other models. And then thinking through the financing piece. So probably the main question in this bucket for me was, because I came into this knowing that I'm not going to have any issues raising whatever the initial 500,000 to $1 million in pre-seed funding, but it matters to me if it's institutional versus my own money or my friends and family money. And this came from a very personal look at, I had built 3 small businesses before, not venture-backed, so a storage company in college, and then 2 e-commerce companies. And when I was thinking about how I thought about capital allocation and how to invest, I grew up, like my parents are immigrants from China. We grew up with very little, and I've had ingrained since I was tiny baby, like be as frugal as possible. And I saw that reflected in a lot of my decision making from my prior small businesses. So when I looked at how I've allocated capital in the past, I've had experience with, my small businesses negotiating like hardcore for $20 off a photography session. And then I had Uber, which was more of a blank check environment. And I knew that if I was funding my pre-seed with, let's say, my own money or my friends and my family, my approach to decision making on how to think about capex, capex investment, for example, I would just be too frugal to think about it in a way that's like, oh no, that's my parents' money. I knew I would be more risk averse and not necessarily make the most objective uh, decisions and rational decisions for what would be a venture-backed business, which is very different mindset of thinking about capital allocation. And then lastly, in the resources bucket, so I thought about this a lot with my personality and what brings out my 10x or what brings out the best in how I come up with ideas and research and build. And for me, I don't know if you can tell this, but I lean more on the extroverted side. And when I was comparing a scenario in which I'm, sitting on my laptop or at a Starbucks at home versus being surrounded by energy of entrepreneurship around me and having an office space to go to uh, and all that to give me the right energy to fuel my company building. That was really important to me, and I knew would make a substantial difference in really getting started. And then so I walked you guys a bit through how I thought about my own self-reflection.
I'm sorry, I'm going to interrupt briefly. We have a small technical snafu, and I'm sorry about that. I didn't mean to interrupt your flow, but could you mind turning your webcam off for a second and trying putting it back on? See if we can get your video back on.
Is it working now for Bruce?
No, I'm going to try something probably very dangerous. Oh, you're back. Perfect. Okay, great.
Always a good simple reboot actually solves most.
Okay, sorry about that.
Yeah.
Keep going.
No, all good. So I just walk you guys through, parts of my self-reflection process and identifying what it is that I need to make me a successful venture-backed founder. And I listed some of the trade-offs here in each of these three potential pathways. So I think the main trade-off is economic, right? It's founder dilution. And we'll go into that in the next slide in a bit more detail. But I think it's important to take, what we discussed from the last slide on, okay, self-reflecting, what am I good at? What do I need? What's going to make me the best founder in the ideal environment for me? And then you start to tie that together with some of the trade-offs listed here. So it relative to the biggest economic difference, which is founder dilution. So taking a few examples with Accelerator. So this is pretty standard across YC, founder startups, et cetera. You have these modular events and networking sessions to help you refine and get more introductions and feedback from people within a roughly 2 to 3 month time gated program. Most, if not all of them, offer access to lots of partner discounts. So AWS, Airtable, Zapier, et cetera. You'll see like a laundry list of discounted SaaS services you can get. And definitely alumni network. So I would say a broad directory and scope of people that you can tap into to reach out for advice and help. And then in the third category, so studios, as I mentioned, this is far more hands-on. So relative to the more founder dilution you're taking at this stage, the benefits that you get are lots of in-house resources, assistance. I talk to Fabrice and get feedback from him all the time. For example, with Atomic and Science, they have dedicated like in-house engineers, designers, sales teams that are dedicated to ideation and validation to get to that final idea of what is going to be built. And then an additional benefit, and I'll talk about this next slide, is also the amount of funding that you would be getting in each of these categories. So in summary, I think the most apparent one is founder dilution, but I think this is a super unique and personalized decision that you have to think about your own trade-offs and how you value each of these incremental benefits to your company building process. So there's no magic calculator that is going to, you input a bunch of things and outputs like this is the right pathway for you. I think it's a deeply reflective exercise, and you should think about, what would I really be extracting from each of these potential pathways, and does that tie to, my self-reflection exercise of what I need. And then, so we covered some of this, but in summary of thinking about financing considerations, I highly recommend that Fabrice has published this on his blog, but if you're building a marketplace business, for example, take a look at our marketplace matrix to see, in market right now, what are we seeing in terms of rounds, investments, valuation sizes, et cetera. So that is the do-it-yourself pathway. One thing that I've seen founder friends do is, if they're building their own key advisor group, they might give, a small amount of equity in order to design that mentorship and structured guidance upfront. The second category, accelerators. So some meaning more of the pre-idea accelerator. So Antler, Entrepreneur First, they offer a small stipend for the duration of the program, roughly $2,000 to $3,000 a month. And if you look at the investment and round sizes, typically all the investments relative to equity are pretty comparable. So YC is 150 for 7%, 500 startups is 150 for 6%, but you also pay a program fee. Entrepreneur First is 100K for 10%, and Antler, I believe, is 150 for 10%. And then in the last category, you have studios in which frequently the studio will offer you a salary if you're brought in during the early ideation process. If the studio is also tied to an investing arm, you may be asked to help with investment activities, which is what I have been doing with FJ, and is super helpful to sit on the other side of the table and understand how do investors think about and debrief and analyze founders and business models that go to them. And then there's also enormous variation in round sizes and investment relative to founder dilution in this last bucket as well. So again, taking into account what are your trade-offs. This is super different case by case. But important to have all these options lined up to properly compare. And an important part as well in my process is properly comparing at the right stage. So when I was collecting data points, it was actually really hard to delineate is this is this post-financing? Is this pre-financing? Is this including ESOP? Is it excluding? So building that comp set was pretty challenging, but I think important if you're comparing apples to apples, taking that slice in time to make sure that you're actually doing it comparably.
In fact, what I would recommend most people do is create your cap table, right? Create a sample cap table. If I'm doing it myself and with or without co-founders, what does the equity split look like there? When you do your pre-seed round, you're raising whatever, 1 at 4 or 5, so that's 20% dilution, and just walk it through in both cases to the difference. Understanding, of course, that it's not just the dilution that matters, but frankly what you're getting out of this. And de-risking the idea may be very valuable to you or not. Having a salary to to be in a position to comfortably take your time to pick the right idea, may be valuable to you or not. And also, what does your network look like? As I said, if you're a second time founder, most likely you're going to do it yourself. You already have VC relationships, you already have a network of people you're going to be building the companies with. You don't necessarily need all the help. As a first time founder, I think all three paths are viable. I don't think one is better than the other. I think Nancy pointed out these are personal decisions. It's based on like the depth of your network, your knowledge and comfort in the industry, whether or not you have an idea or you need help finding an idea, and all those things will play a very important role in terms of what makes the most sense for you.
Yep. Yeah, exactly. And that's actually exactly what I did for Reese. I built my own test cap table and played around with the inputs on, I'm probably going to find a co-founder, et cetera, and all these factors. But then it comes to where do I see the value in these scenarios relative to what I see in these cap table scenarios. Yep. Cool. And just in the interest of time, so I'll walk through an accelerator example YC, as well as studio example at FJ Labs. Super high level, just given there's a lot of literature on this already. And next week, Fabrice will be doing a deeper dive on how we go about our studio model. But at a very high level, and to point out a few distinctions more granularly here. So YC programs, it's 12 weeks, 2 batches per year. They're fairly large. So for example, last year, 2 batches had almost 200 companies in each. And you must apply with an idea. So, one distinction for me as I was thinking about it was I want to build something. I want to build something impactful and at scale, but I need time and diligence and to follow methodology without rushing into things, which is why I wanted to work with a studio or other firm that would invest in me pre-idea. So YC, you must apply with an idea. And, funding is pretty standard with other accelerators or in line, 150K for 7%, ends in a demo day for which companies will then raise their seed round in the following weeks. And the resources here, again, I won't reiterate too much, but really, really large and valuable alumni network and a structured set of programming that guides you throughout those 12 weeks. That's a blend of educational as well as networking.
Before you switch slides, one thing I'd say is, and stay on the YC slide for a second, there are 2 categories of companies that I think should, if they can, kind of always go to YC, just because it would be a fundamental comparative advantage. And I think if you're a foreign founder, and so a non-US company, it's actually a lot harder to raise seed money to get attractive valuation. So if you're a non-US founder, you can get a YC, your visibility will be so dramatically improved. The valuations you can command are so be so much larger. It'll totally be worth the dilution of the 7% for the 150. That, and including their 7%, you're going to raise at such higher prices. I mean, you want to make sure you don't necessarily price yourself too much on a go-forward basis. It'll be worth it. The other company that I think should always go to YC is a B2B SaaS company that focuses on selling services to startups, because their network is so deep that it can completely change the game in terms of like getting you off the ground with a massive number of clients. So B2B SaaS trying to sell Microsoft, not necessarily, but like B2B SaaS trying to sell to other startups, I think it played a fundamental role in getting Brex side of their early success and early traction, which put them on the stage for being a unicorn today. And I long chats with Enrique about this, and I think it's in these 2 cases, if you can make it in, it's definitely a no-brainer. The rest, obviously, the other nuances, and then as you mentioned, come into play.
Cool. And I won't go into this in too much detail since this will be covered in next week's session, but so FJ Labs example of the studio model. So as you can see, in contrast to the YC model, much bigger investment, 750 for 35% pre-seed, and then subsequently 2 million. And then application-wise, you'll notice, for example, much smaller batch sizes. So in relative to the 200 per batch in YC, Fabrice and Jose, work really closely with two apprentices recruited from MBA programs each year. So much more hands-on and custom tailoring and feedback from that structure.
Yeah,
And
yeah, no, I was gonna say like I think one big difference is by the time you pull the trigger and say, okay, this is what I want to do, work with FJ. At this point, we've worked together for like a year, right? So in a way, there's like a lot of founder dating and mutual due diligence. We understand what we're good at and whether or not it's worth it. And obviously, when you sign up to be an apprentice, you can always opt out and not become an EIR if it's not right for you.
yep, exactly. And yeah, I don't want to bleed too much into next week's session, so just keeping mind of time. Uh, Anything else on those for Reese's last slide?
No, I think that's it on the slides, but we do have a fair amount of questions that people are asking, and frankly, maybe sorry, question for you, which is ultimately you chose to be in the IR here, so you went through this, you looked at the cap tables. What were the factors that weighed in for you that made you decide, okay, this is the right path for you?
At FJ specifically,
Well, yeah. Well, obviously,
or
you didn't need to accept the FJ offer, right? Like, you could have gone. In your case specifically, you could have done on your own. You could have gone in Accelerator. You chose FJ, or well, you chose Studio, and within Studio, you chose FJ. So maybe thinking or walking us through for you how that decision process went through, and then we can look at the questions that people have in the audience.
perfect. Yeah. So and also looking back at the past year and a half that I worked with you, Fabrice. So the one of the main ones was focus on marketplaces. So I am an economist by background. And when I think about my love for marketplaces from Uber and also the business models that I like today and in the future, they're all marketplaces. And there's something really amazing about matching what is already existing on the supply and demand side, and how do you figure out this is already out there, and then how do you generate value from that matching that doesn't exist today and create an amazing experience on both sides. So for me, I just love the marketplace model already and knew that I wanted to build something in marketplaces. And then second, when I think about my 10x skill set, it's not like computer visioning or like more the deep tech stuff is actually okay, like ramping up a team, like figuring out operationally how to scale, like how do you allocate capital and resources super efficiently, and how do you do this across different functions of a company. And for me, that skill set also aligns to what you need to be successful. So for me, interest and my 10x skill set to the team on the investing side and other EIRs, also mostly in marketplaces. And I knew that would be amazing and specialized expertise for what I wanted to do. So that's reason number one. Reason number two, if there is something that I've learned through any of my work experiences, like the people matter to me. Having I saw it in the first week as a summer intern last year. I like fell in love with the people like day one. No, in the interview process, I fell in love with the people, and I really valued a culture that would give me data driven feedback, like flat, would be really open and transparent, and would push me to be the best that I could be. And for me, that was FJ, and really apparent when I, was chatting with, other options. And for me, that resonated a lot. Yeah, I'll just stop there because I could probably go on.
Okay. When you think of accelerators, do you think there's a fundamental difference between YC and then the others, like Techstars, 500, etc., or do you think the quality is is pretty close, or is YC in a special batch of its own, or you think they're all really the ones you mentioned, and maybe adding tech stores to those are all pretty amazing, or I don't know what the current market sentiment is from an entrepreneur perspective.
So I I didn't investigate this too deep, but at a very high level, what I gathered was um, they are very similar, and the programming, the alumni networks also tend to lead into each other. Um, so I think in terms of what is most reputable, like probably YC, especially if you're a non-US based founder. But I'm also observing this, the accelerator model is becoming increasingly commoditized over time, especially as the availability of information is like publish more content every single day. Steve Schlafman has a really good founders library. Gary Tan does amazing videos. Obviously, Fabrice's stuff on marketplaces. So there's a lot of resources, I would say, in the last few years that like perhaps you could get that like otherwise would have been unique to a YC or 500 startups before a few years ago. But I didn't dig enough
Okay,
deeply.
but that's fair. Um, so, your sort of how much do you interact with me as part of this process?
Yeah. So right now I do, you know, every 3 weeks incubation calls with the broader team. And people take this very seriously. So everyone on the investment team, other EIRs, Fabrice and Jose always attend, and you deep dive on what are your findings and what ideas have you killed or progressed on in the weeks prior. And so I would say that is probably the biggest team uh, in-depth look at what I'm building. And then one-off, like Fabrice and Jose are super responsive to email and WhatsApp and Slack and every day. So I feel super open and knowing that I'm going to get a response within a few hours from either of them or the rest of the team. But I would say from a structured standpoint, it's like every whatever 2 to 4 weeks incubation update call, and then aside from that, like regular one-on-ones, and then for any back and forth async like questions, like feeling that I always have a support network and having knowing that I'm going to get a response because I'm in the area FJ, like Fabrice and Jose are super responsive.
So I know in a few weeks we're working on presenting how do we both ideate or find ideas, and then how do we evaluate whether the ideas are good. But David would love to hear a bit more. How do we de-risk ideas? What are the things we do prior to pulling the trigger to make sure that this is an idea that's worth pursuing?
Yeah. So we'll have a more structured view then. But let's say you have arrived at, you have whatever, you're pretty sure of this idea, you sense some problem in the market, and here's a business model that you think could solve for that. So I think, and this is super different if this is a consumer facing versus B2B company. So for consumer facing, it's much easier to early on, like go out and test and whatever, like just set up a Webflow or a Wix, and then spend a few $100 on Facebook, Google ads, and validate like, is the value prop that I'm presenting, like, is this a real pain point? Is this true? And there are mechanisms in which you can quantitatively through Facebook, Google ads do that on the consumer side, but also qualitatively either via surveys or through your interviews and conversations, being able to codify, let's say like create your own segmentation of different personas or customer type, and be able to highlight, oh, this is a pain point, and they have demonstrated through conversations a willingness to pay or whatever from that. So that's what you can do qualitatively and quantitatively on the consumer side. On the B2B side, obviously, you can't just roll up a Facebook ad and target someone who is whatever CTO or VP of IT on the B2B segment. So that is going to be less straightforward because the acquisition channel is going to be more about sales. So that will tend to lean more initially on interviews, like lots and lots of interviews. Highly recommend the mom test. There are really important nuances and distinctions in how you ask questions about value prop, pain point, willingness to pay that are like might seem like silly when you first skim through what the mom test is, but actually look and read it and look at the examples, and you'll notice, and I notice this too as I refine my questions, you get much deeper insights with pretty slight tweaks to how you present something or ask questions. So that is super helpful and important to get really tight on that on the enterprise side. And then perhaps depending on what you think is acquisition there and validating, like LinkedIn is super expensive. It's like $20 CPC. But there are some ways in which you can test or reach out to your network of potential buyers and validate more through interviews, or if you think it's through a sales outbound team or inside sales, perhaps like LinkedIn for the initial lead list and then do a call, but you can kind of model out what the qualitative and quantitative scenarios are to validate. But we'll go through that in a bit more detail in a future session.
Yeah, I mean, to give people a sense of the funnel for us, every year we come up with 200 to 300 ideas. We evaluate dozens, and we build 2. And so before we pull the trigger, and usually as we're evaluating dozens, I mean, we're doing hundreds literally of customer interviews, landing page analysis to analyze customer acquisition costs, estimates on like conversion rate on the sales team, looking at the unit economics, every theoretical unit economics. So a lot of work goes in to make sure that we've de-risked the idea as much as possible before we pull the trigger. It's not to say all the ideas we do work out. That's not the case, but if you think that the 5-year survival rate of a startup is about 7%, our success rate and our survival rate has been a lot higher, so something seems to be working reasonably well. So quickly answering the remaining questions are somewhat different. So I'm not in Cabarete. I'm actually in Turks and Caicos. I moved away from Cabarete a few years ago. And in terms of, let's see, the best way to reach out to me is probably on LinkedIn, frankly. I mean, it's not that hard to guess my email, but if not, reach out in LinkedIn, but don't just reach out with, oh, I need help, I want advice, etc. Like, it has to be a marketplace. You need to have traction. You need to include enough information in that message for me to be able to respond. And as Nancy said, next week we're going to be covering exactly how the FJ Lab Startup Studio model works. Everything from recruiting all the way to the summer program, your second year program, your time as an EIR, and then what's it like to be an entrepreneur. And we'll have 3 guests who will discuss the different elements of that, and we'll take it from there. So this was a great week. Thank you, Nancy, for joining us, and I look forward to chatting with all of you guys next week.